This is Trepp Week in Review for the week ending June 30th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. The world watched nervously late last week as a brewing coup in Russia had people across the globe on pins and needles, but a quick resolution put investors at ease by Monday morning. Elsewhere, there was plenty of positive economic data this week as consumer confidence and new home sales came in well above estimates. Fed Chair Powell was quick to take the punch bowl away, though, commenting that several more rate hikes may be necessary before the Fed can declare victory over inflation. And there were several big comps for CRE investors to digest. Manus, it was an interesting week. What were your takeaways?
Well, I would say it was a week with three parts. This open maybe quite lengthy because there's so much to talk about this week. This is a very meaty week in terms of data points for us to go through. So we'll try to cover them all and we'll try to do it expeditiously. So my first takeaway for the week was Russia. Certainly there was rumblings on Friday last week that a potential coup was brewing. By Saturday morning, the world was in full panic that Putin was fleeing, that Moscow may fall, that Wagner's troops were marching towards the capital. And I think people were very nervous, and rightly so. An agreement was reached on Sunday, and by Monday morning, there was a collective exhale. I think had that not happened on Sunday, had we opened on Monday with the market still facing troops marching towards Moscow, I think we would have seen a catastrophic drop in equity prices. I would have thought like a Dow down 1,500, S&P and NASDAQ down 2 or 3 points was probably the baseline case. Fortunately, we saw an agreement cut on Sunday, which took that off the table. But I have to say, I was staggered by the blasé reaction of the marketplace on Monday. Even though we avoided catastrophe and avoided perhaps a toppling of the Putin government in Russia over the weekend, I thought this would have served as kind of a sobering moment for investors that the world is still a very dangerous place. Unexpected twists happen. And I would have thought we would have seen a lot more negative sentiment on Monday. In fact, we saw almost none as people moved on very quickly. That took me by surprise. But that was really Act 1. Act 2 was an enormous wave of positive economic data that we'll go through momentarily. And then the third act was Powell again taking away the punch bowl and saying that more rate hikes are necessary.
Yeah, I think you did a really good job of kind of covering what took place with Russia, and our sentiments are aligned in the sense, you had reached out over the weekend and we were willing to jump on and do an emergency pod had, things not de-escalated over the weekend. I was surprised as you were that the markets reacted the way they did. Obviously it's great that there was a quick resolution and tensions de-escalated. But to your point, we're still in a very fragile state across a bunch of different geopolitical realms. And it's just interesting that we've almost become numb to some of those outputs in the marketplace. And so it'll be interesting to see what the repercussions are for Russia based on what happened this last week. Obviously, Ukraine took advantage of some of that unrest and advanced their positions, which, thankfully the Russia stuff de-escalated, but maybe it escalates further some of the Ukraine conflict. So, something for us to keep an eye on from my perspective. I don't think that we're done with that. I think the markets had a very tepid response, which was a little bit surprising. But at this point, I'm not really surprised at the market's response to most things because it feels like it does, opposite of what I think would happen. The economic stuff is good. I mean, I think we have a lot of good information coming out. Consumer confidence increased. The index increased to 109.7 in June, which was up, fairly significantly from 102.5 previous. Core capital good orders rose 0.7%. Shipments were up 0.2%. New home sales surged, over 12%. There were gains across all 4 regions. So, I mean, if you look at those things, all positive. If you look at even single family residential, the mortgage side of the business, demand has grown. So that increase in new home sales has really translated into more mortgage activity. So even with interest rates increasing, average 30-year interest rate on fixed rate mortgages, these are non-jumbo loans, so what we would call conforming loans, even though they went up 6.75% from 6.73%, applications for home purchases also climbed 3%. So they're down year over year, but they're still up relative to what we've seen in the last couple of months. And then applications to refi, this was kind of an interesting stat this week. Refinance applications rose 3%, which we have talked about on the podcast before. Given the current rate environment, refinancing doesn't make a lot of sense for a lot of people. But there's been some good news where, they've at least seen some uptick there. So I think those things, coupled with the revision for first quarter economic growth, which was revised up to 2%, was initially reported at 1.3% for GDP. I think that bodes well for overall state of where we're at. And, I think it's been a very busy week. As you mentioned, we have a lot of stuff to cover. And I won't go into the details of what Powell said. I'll let you maybe take the lead on that. We can bounce some stuff off each other. But all in all, given where we were at come Friday and Saturday, I think it's been a pretty good week for the markets.
Yeah, a couple of things to talk about in that realm. First of all, on the GDP number, it certainly was helpful to the stock market today. Dow was up big, S&P 500 was up pretty considerably. The NASDAQ was flat. And that was largely because that uptick in GDP really pushed Treasury yields sharply higher today. We have seen kind of a rough month, if you will, for yields. The 2-year today, after the GDP number, spiked 16 basis points. The 2-year is now back up to 4.87%. These numbers are very quickly becoming a renewed source of pain for anybody who needs to buy interest rate caps. The 2-year, just looking back, the 2-year was only at 4.33 at the beginning of the month. Now it's 4.87. So up more than 50 basis points month over month. The GDP number today pushed the 10-year up to 3.85. It was up 14 basis points today, up 25 basis points month over month. So that would explain why today the NASDAQ was flat. Tech stocks by their nature are more sensitive to higher interest rates. And that's why we saw the other broader index, the S&P 500 and the Dow, outperform tech today. But it is a little bit alarming that we've seen such a spike in interest rates over the last couple of days. And in addition, Powell made it very clear this week that he's ready for more interest rate hikes. He was quite blunt about it. He said we may need successive interest rate hikes again in coming months. And he was already on record as saying a 50 basis point hike, not in 1 month, but consecutive 25 basis point rate hikes could be necessary. It certainly has the potential to weigh on the markets going forward. So as I said in the beginning, lots going on this week. Russia, great economic data, and Powell there to keep us all level-headed and sober.
Yeah, I think it's interesting. He has not wavered from his bringing inflation down to 2%. And so even with, some of the bank turmoil and these other things, he's been pretty adamant there. So it'll be interesting for us to just see at this point, is it just hawkish talk and tone, or are there actually still some rate hikes to come? His message hasn't changed. I will give him that. He's definitely, kind of stood his ground from a policy perspective of saying 2% is the target, and he's been unwavering. It's a message, and he was actually at a moderated discussion this week in Madrid. So it's not like he's just saying that while in the U.S. talking his book. He's saying that on a global stage. So it'll be interesting to see what they do in the next couple of months. I think the markets would like to get some certainty, though, from them, either in the form of another 25 basis point hike, so they know that there's maybe one more left, or him coming out after another, decision to maybe hold off, and then they can start pricing in, the terminal rates being what they are now.
Can you picture Powell at Reagan National on his way to Madrid, kind of saying, "Good God, a banana for $4 here? Like, I got to get this inflation under control. Bottle of water, $7. Come on, guys." Like, I just have this image that, a lot of these guys in Washington live in their cocoon, and here he is out there, and maybe he's living the way the rest of us do right now, saying, "Holy moly, a croissant for $9? I don't know. We'll have to see. I want to throw this at you, Lonnie. This is a little bit of a detour. I got this from our friend Orest, who's been a guest on the podcast before. He was pointing out to me, we wrote about this, I think it was yesterday. There was a big refinancing in Los Angeles. The Park La Brea, I think it's called. It's a big 4,000 unit apartment complex. They had something like 3.2% debt in place, refinanced into something that was more like a 5 handle. So negative on the rates, locked in for 10 years. So Orest went out to the borrowers, and you can find this on his website. And if you want to, we could try to get his article and pass it to those that reach out to us here at the podcast. But, we were scratching our heads a little bit and saying this is kind of a upward rate refinancing for longer term. So Orest reached out and he learned a couple of things. I thought these were interesting. First, the borrower wanted to hold on to this property in perpetuity, was afraid of higher rates, wanted to lock in today. That makes sense, right? He was facing something maturing in a couple of years. But something I hadn't thought about before, or at least hadn't thought about in a while, the existing loan had to be defeased. When you defease a loan, you buy treasuries to replicate the cash flow of the loan that you're going to pay off. And Orest reported that the defeasance cost to take out this existing loan, because they were able to buy treasuries at a big discount, provided a huge tailwind to them. They basically were buying this, and I forget what the discount was to par, but it was several points of savings. So it's not like they refinanced from 3 to 5. They refinanced from 3 to 5, but they got the offset of paying back that loan basically at a discount. What are your thoughts about that, Lonnie?
Yeah, so for those that are maybe newer to the podcast, you actually, I think, put on a really nice education segment a few months ago, and we actually sent out a spreadsheet to a few folks that wanted to see how that defeasance process worked. And it's interesting that you bring that up, because we haven't really talked about it now, but I wouldn't be shocked to see a few other folks take advantage of the tailwinds, especially if you're a long-term holder of the asset. So in this case, I think that's kind of a linchpin for this deal. Is, to your point, they want to lock in the debt for a longer term, even though it's an uptick. The previous 3 point whatever rate that they had was probably an aberration in their mind relative to historical norm. If they could lock in a 5 handle and they get the tailwind from the defeasance, I think that's something that we might start seeing more of. The one thing I've learned over the last 6, 9, 12 months, call it, is a lot of these things that are maybe textbook or theoretical in most markets are actually having applicability in some of these current dynamics. And so we talked when Orest was here last time, we actually talked about lenders taking equity positions and other things in the deals that they have financing on. And we hadn't seen that since maybe the last downturn. Now we're seeing people, willingly refi when maturity is even not on the table today into longer term higher debt, because there's some opportunity to buy down or pay off at a discount. So I'm glad we get to report on this stuff. Orest does a great job getting the scoop and the full story. So it's great that we're able to leverage his expertise as well. And I wouldn't be surprised if we don't see more transactions like this over the coming months.
Yeah, I think that, I'll throw this out for the newbies out there. I guess people that have been in the market a long time would know this already, but when you are taking out a new loan that is 10-year fixed in the CMBS market or through Fannie or Freddie, normally you have one of two types of prepayment restriction. One is yield maintenance, which means if you refinance into a lower rate, you basically make whole the lender by paying a sum, which is the difference between what you saved by refinancing into a lower rate. And usually there's a floor on that, like it can't go below 1%. Or you're locked out, which means you can't prepay at all, but you can defease, which means you replace the cash flow with treasuries. And I don't want to get into all the details today. Maybe it'll be an educational segment for the future. But generally speaking, if you think long-term rates are going up, you're probably better locking yourself into something that has a defeasance, because you could effectively retire this loan at a discount, whereas the yield maintenance is floored. If you think rates are going to come down, you're probably better off with yield maintenance, because yield maintenance usually comes with some kind of premium to the treasury curve, which allows you to pay something less than the yield that is on treasuries at that time. So I'm just throwing it out there. If that begs a lot more questions on our listeners' end, feel free to reach out to me, and I'm happy to respond, but that's kind of my hot take on this particular story. So a nice little, sorry, Haley, 5-minute detour on defeasance, yield maintenance, and discounted prepayments.
So one more news item this week was Bed Bath & Beyond and their auction.
So there was a couple different auctions. One was their IP, which I think was acquired by Overstock.com. That gives Overstock the ability to sell through their website and so forth. But they also auctioned off, I think it was 100 plus leases, give or take. We reported on that this morning. There was a gentleman, Mr. Reed, I forget his first name, Bill Reed, I think, who put on his LinkedIn the auction results on a spreadsheet. The big winner of the auctions, which is basically you are taking over the lease of Bed Bath & Beyond from them. The big winners were Burlington. They won 44 of the leases out there. And I think the total number was 109, 110, something like that. The landlords themselves took 37. I think Michaels took 9. And then it was a smattering of others. I'll take your reaction to it, Lonnie, but it seems like this is a green shoot, that they got bids for these, people want these locations, and they're not going to sit dark for very long. What's your take?
Yeah, I'm very similar to yours. I think this is a green shoot for the market. It shows that there was ample bidders, activity, and some of these names that acquired the leases, Burlington Northern, as you mentioned, Michaels, Barnes & Noble actually got 4 of them. Aldi, the grocery store, had 1, PGA Superstore. I think this bodes well for the market. I also just say anecdotally, as Bill Reed assembled this data and put it out on Twitter and LinkedIn, what a time to be alive for those of us that are deal junkies. I mean, you have people that literally are taking these transactions, putting them out there available for people to read, learn, educate themselves, and see what's happening in the marketplace. And so kudos to him for putting that out there. It gives us something to talk about and just showcase, bring some light or transparency to an otherwise kind of opaque part of the market. So I would take this as a green shoot all day, and it'd be interesting to see what happens from here.
I was disappointed that we didn't see among that list the Trepp podcast Superstore winning 1 or 2 of those locations. I think it's long overdue for us to start, having the Trepp podcast experience full with various t-shirts with slogans like crabgrass and green shoots and all right and everything else. I think the next time we see one of these auctions, we're going to have to roll the dice. Maybe Simon, our CFO, will greenlight, the financing of one of these things, and you'll see us between the Petco and the Joann's.
Maybe we'll start with an online store, then move to big box. We'll see.
Yeah,
we'll see if our listeners are interested in that.
Yeah, I think Haley's going to be spinning up an online retail store before she releases this week's pod. So more to come on that.
Haley going full Powell, taking the punch bowl away from Manus in very short order.
So today we had some breaking news for our Trepp clients. We released our June 2023 delinquency report. We also shared a sneak preview on Twitter, so you may have seen that. But Manus, why don't you run through the numbers?
Well, we've used the word sobering a couple times already in this podcast, and the numbers are again sobering. They show delinquencies continuing to climb. The June 2023 headline number is 3.90%, which is a 28 basis point uptick from last month. The rate is now up 86 basis points from 6 months ago. So delinquencies continue to rise. We did see a very sharp increase in the hotel rate, more than 100 basis points. That was a function of 1 or 2 big single borrower hotel deals reaching their maturity date and not paying off. That pushed the rate higher this month. We already said last month that once the big San Francisco hotel loan goes delinquent in July, that will push that rate up another 80 basis points or so. So some real negative news on the hotel side. Offices, again, an uptick in the delinquency rate. It has slowed. It's not accelerating as quickly as it was, but it was still sizable. Delinquency rate in offices, 4.50% in June, up from 4.02%. So an increase of 48 basis points. And if memory serves me well, I think we're up about 2.5 percentage points over the last 6 or 8 months. So office really moving up at a very quick clip. And Lonnie said a week or 2 ago that he didn't think a 10 handle on office delinquencies was out of the question.
Yeah, I would maintain that position. I mean, at least we saw a little bit of a slowdown in the increase, but almost 50 basis points month to month on the heels of what we saw last month, I think doesn't bode well for office. I think the lodging sector is an interesting one to keep an eye on. I know this was skewed with a couple of big deals, and there's another big one coming up potentially in July, but that doesn't look good. It's over 5%. It could go up to 6+. And I think some of the tailwinds that the hotel industry's had coming out of COVID, with people traveling and feeling cooped up for a year plus and then getting out, like there's potential for that to slow down some. So something to keep an eye on there. I wouldn't have ventured to guess that number would be as high as it is if we had, talked through this 6 months ago. And some good news, retail was down almost 20 basis points. So that one's kind of been hovering in that 6.5% range for some time. And so it was good to see a little bit of a decline there on the retail sector.
One thing that will be, I think, in stark contrast during this cycle to what we've seen in past cycles is the size of the loans that go into default. Historically, these SASB loans, which stands for single asset, so a loan backed by a single hotel or shopping mall or office, or single borrower, which means a portfolio backed by Ashford Hotels or something like that. Historically, defaults in that segment have been minuscule over the last 10 or 15 years. It has been the smaller stuff, the conduit stuff that has really dominated the liquidations and the losses and so forth. And we seem to be on a pathway that will be 180 degrees different this time. People at CREFC, our trade industry conference 2 weeks ago, talked about how borrowers with smaller properties, smaller loans have been muddling along and refinancing their properties. And it's the big guys they're worried about. And, I think that's what we're seeing play out. And I think we'll continue to see that. And that will go a long way to whether or not we get that 10% number that Lonnie, thinks is possible.
Yeah, and we've already seen this with the RXR announcements, the Brookfield and some of these others of making the headlines saying they're giving the keys back. A lot of those properties would be part of those SASB deals. There was a lot of issuance over the last couple of years in SASB in particular, where you started seeing them actually outpace the conduit markets. And so, there's a greater instance of SASB deals now that maybe have some potential trouble in line for them. So definitely something to keep an eye on. Hopefully I'm wrong. Hopefully we come back next month and office hovers at 4.5 or goes down. I'm certainly rooting for the office owners and don't want to see a 10 handle, but I just think there's still some headwinds fighting for that industry.
So we have a lot of property type news to cover this week. Let's jump into office.
So yes, we had actually some nice green shoots this week. Plenty of crabgrass, as one would expect, but there were some positive signs. The most positive, for sure, was something that we circulated via an email earlier this week. The news came from Rich Bachman of The Real Deal. He's been covering the market, the commercial real estate markets for a long time, does excellent reporting for The Real Deal. He wrote that Morey Trust had bought 49.9% of 245 Park Avenue. It is a 1.7 million square foot office near Grand Central, not a brand new office like we've seen with One Vanderbilt. So it's not sparkling brand new, the kind that has attracted $300 a square foot at some point. So why did this catch our attention, and why was this such a positive development? Well, number one, anytime somebody pays $1 billion for a 50% stake, you feel pretty good about that. A real vote of confidence for the New York office market. Number two, this property was worth $2.2 billion when a loan was made on this in 2017. So if you're talking about the valuation discount, we're talking only about 9.5% versus this 2017 value. This property itself has had a lot of turmoil. It was owned by an affiliate of H&A. H&A is a big Chinese investor. Their affiliate filed for bankruptcy. The property was later sold to SL Green. Before it was sold, SL Green was managing the property, and they were threatened with a lawsuit by the owner in their management capacity, but they ended up buying the asset. The property lost Major League Baseball as a tenant a couple of years ago. So a lot of moving pieces here. And in addition, it's in a market where JP Morgan will be putting a new tower up, or they're almost done with the tower. They will be taking a lot of their existing office space and moving workers into this new tower. So that part of the market is in flux. And for something like this, in a market with so much negative sentiment, to have only a 9.5% discount to the 2017 value, I think was terrific. And I talked to some really bearish guys this week, and I have to say, even they were saying this was an undeniable green shoot for the market. So that was really nice to see.
My question to you would be, does the location, near Grand Central kind of override some of the other potential risks with JP and others in that market? From a longer term perspective, do you think that maybe plays a positive on the upside here for the long-term prospects of the building?
Well, I think you're spot on there. I think that we are going to see winners and losers within New York, and the winners will be clustered around places that make one's commute shorter. What we learned is that people don't want to commute at all if they can help it. But if they're going to commute, they want to not ride 2 trains, they want to ride 1. And that does not bode well for things like Lower Manhattan, Union Square, maybe that 6th Avenue corridor, which is kind of a bit of a hike from Grand Central. I think those clusters around Grand Central, the Port Authority, Penn Station, will probably outperform the broader market. But to be quite honest with your question, I did think that the JP Morgan and that space coming online would present a bit of a drag on that Park Avenue corridor, and it certainly didn't in this case, and I'm really happy that that's the case.
And I think we have even more positive news.
So yeah, we'll run through a couple of others. First one comes from Commercial Property Executive Raluca Toma. I hope I'm pronouncing that correctly. Franklin Street Properties has inked a 120,000 square foot renewal with Kaiser Permanente in Greenwood Plaza. That's in Englewood, Colorado. So we're really happy to report on that. Healthcare firms have been some of the biggest returners of space across the US. Kaiser themselves have given up space in droves in California. So for Franklin Street to renew this lease, I think is a real nice green shoot. And then in Florida, we like this one as well. Normally a story like this, a year ago would have been quite ho-hum, but 111 Magnolia in Orlando has been refinanced. Morgan Stanley wrote a 5-year loan on that 320,000 square foot office in Orlando. Why did this one catch my attention? Well, first of all, the property itself makes up almost 10%, or the loan makes up almost 10% of a 2013 deal. That's the loan that will be refinanced. It is part of CMBX 7, and it had suffered from low DSCR. DSCR in 2022 was only 1.09x. So for this thing to be taken out in a market with such negative sentiment, I think is a nice green shoot. Some of those bonds were trading at discounts, bonds that were backed by this Orlando loan. Those things should be paid off at par next month once this thing gets refinanced. So not all the stories in office are negative, and we're happy to report the positive ones.
But now we do have negative ones, right?
We do have negative ones, yes. And unfortunately, we do have to report on those as well. First, in the sublease segment, running through these very quickly, just a couple of big ones. Redfin in Dallas giving up another 40,000 square feet. They were already on the hook to give away 20,000 square feet via sublease. They're now going to bump that up to 60,000 square feet. In DC, Meta is going to shed 120,000 square feet. And in Seattle, which, this is actually Bellevue, Seattle can't catch a break right now when it comes to office demand. We've reported frequently about how much space Microsoft has put back on the market there. This week, the Puget Sound Business Journal reports that T-Mobile is putting another 300,000 square feet out for sublease in Bellevue. That report comes from Alex Halverson. Just an enormous wave of space becoming available there. A lot of that space in Bellevue and Seattle was securitized not long before COVID. And that market may see some bumpiness, some turbulence in the coming years, just by the sheer numbers we're talking about.
Yeah, the office market in Seattle, definitely, that's going to be a long recovery for them. A lot of tech space, And there's just not a lot of people that want that type of square footage that can come in and backfill those in huge swaths. So I think you're going to be able to get a pretty good deal in Seattle for the next couple of years if you're so inclined to move there and sign a long-term office lease.
And we got a couple of mixeds. I'll throw them out there, and then we're going to do some sales comps. First one in Houston. This comes from BizNow's Maddie McCarty. She reported that Thompson Co., a big law firm, is going to move from 777 Post Oak Boulevard in Houston to a new development in that city. I think they're keeping their square footage about the same. So a mixed green in the sense that One Riverway, which has already come under some pressure for having lost tenants in the past, and with DSCR less than one, they are now losing their second largest tenant, but a positive sign for, I guess it's called 5 POP, which is at 4400 Post Oak Parkway in Houston. So a mixed green there. And this was an interesting one. The NRA, National Rifle Association, they're now headquartered in Virginia. They are looking to take space in Richardson, Texas, not far from where Lonnie is. This is an interesting story for me. The association is looking for 200 to 300,000 square feet. They are looking at State Farm's City Line location. City Line itself is an interesting story, 2.2 million square feet. State Farm has already said that they want to give away 400,000 square feet of it. State Farm nationally has been giving back space hand over fist in, I think, about a dozen cities. They said that they're giving back space. A lot of that space is sale leaseback that backs CMBS debt. In this particular case, the City Line backs a loan that matures in the next couple months. The owners of that property were hoping to sell the property, use the proceeds to pay back the loan. But I'm not sure how confident as a buyer you are in State Farm's commitment to Richardson in years hence. I mean, their leases start expiring in 2031. They finish expiring in 2041. So the duration is quite long. Maybe you would know, Lonnie, more than me. This seems like a built to suit type of complex. If you're looking at this thing to buy this thing, knowing State Farm's history, are you a buyer of this type of asset? And if so, how do you look at that?
Yeah, I mean, I think if you factor in everything that you just outlined with State Farm, and there's the relative size of this building. I mean, it's a 2.2 million square foot complex of buildings. It's pretty daunting, I mean, even if the NRA moves in and maybe takes in 400,000 of the square foot that State Farm's trying to sublease here at the building, get you some diversification potentially for a longer term play, but not really. The location on this one is good. I'm pretty sure it's on a rail line, so it has a transit, component to this, which is uncommon for North Texas. But there's a lot of debt on it too. It's almost $500 million. And it'll be interesting to see what happens to the valuation on this asset, if they're able to strike some sort of a deal with the NRA. So, this one here, in a normal market, State Farm is a credit tenant. Leases that go out to 2041. On paper, this one looks probably really good. In reality, based on the macro and what State Farm's done nationally, maybe not so good. So I would probably hedge on this one and just say, depends on who I am and what I'm trying to do with the capital, if I'm making a play on this one or finding some other alternative investment for me to put my money.
And this week we saw some sales comps in some cities like New York, Chicago, Minneapolis, and Boston.
Yeah, this is not going to be the pleasant part of the podcast. This will be a little bit tough to swallow. So if you're standing up, maybe take a seat, or if you're driving, maybe pull off to the side of the road. Some of these comps are not going to be very pleasant. In New York City, this comes from The Real Deal, 529 Fifth Avenue. That sale was completed for $102 million. The sale was first reported in March at 105. So this is even less than what was reported in March. The property, while we don't know what it was last sold for, we do know that in 2020, the property was refinanced with a $171 million loan. So if you're using like a 70 or 60 LTV, the value of this thing was probably about 240 million last year. So if you're doing the math at home, you're saying that this thing sold at a more than 50% discount to what this thing was valued at a couple of years ago. One of the haircuts there was that shortly after the refinancing, and this was a Silverstein building, by the way, the top tenant, Citron Corporation, vacated, which put pressure on this thing to keep you from having to pull out your calculator, especially if you're driving. The sale represents about $373 a square foot. The next comp here, this is in Chicago. It comes from our own Commercial Real Estate Direct. R2 Co's, they are paying $70 million for 150 North Michigan Avenue in Chicago. That represents just $106 a square foot. So a terrible comp for that part of downtown Chicago, $106 a square foot. In Minneapolis, this comes from Sean Ryan of the Milwaukee Business Journal, even though it's a Minneapolis story. Hempel Real Estate has acquired LaSalle Plaza in Minneapolis from Northwestern. The price is said to be $46 million for the 600,000 square foot tower. The tower is primarily office, although it does have 60,000 K of retail. The sale price, just $74 a square foot. The last time this building sold was in 2011 when it sold for $155 million. So you're talking about a 2/3 to 3/4 discount from where this sold in 2011. And then lastly, in a market that really has been blemish free for a long time in Boston, this comes from the Boston Business Journal's Greg Ryan. Alexandria has sold some Newton offices, which is a suburb just outside of Boston near Boston College. They sold this life science property for $117 million, which is half of what they paid for this asset 3 years ago. So Mass Mutual and Greatland Realty have acquired this property, which was valued at $235 million in 2020. So life science had really been the lifeblood of the Boston market for a long time. This was a really shocking sale for me.
Yeah, so you ran through several examples there, Manus. And for those listening, Manus was deep in his notes during this rundown of these comps, because the sales price reductions on these are pretty staggering. So, just a couple of thoughts around this. We've talked at length around all the headlines, the doom and gloom for office, and some of the challenges that could potentially play out with refinances, the wall of maturities, et cetera, et cetera. And I think it's kind of grown a little bit stale for some people, where they feel like this negative narrative is out there, but every week we hear about really large loans getting extended or modifications taking place or whatever. So there's really not this downturn that everyone's predicting. But I think these stories you just ran through, Manus, these are probably underreported relative to the narrative, in the sense that in almost every single one of these examples, you're looking at a sales price that's 50% or so of what they recently were either refinanced at or purchased for. So the reality is, like, there are a lot of negative headlines, and there are a lot of negative transactions taking place in the market where the current owner is taking a huge haircut on these deals. The hope is that at these purchase prices, the new operators are able to come in and get the occupancies. I think in most of these buildings, occupancy was somewhere between 60 and 70%. And hopefully with the new reset basis, they're able to put some CapEx into the building. They'll be able to do some things to amenitize the space so that people come back into the office and want to leverage those buildings. And so, I'm optimistic that if this signals kind of the bottom for some of these markets, that maybe we're getting that reset that we've been talking about. And if you look at some of these addresses, 529 Fifth, that's a historically good market. 150 North Michigan Avenue, Chicago, historically strong market. And then the stuff on the life science, we talked about that the last couple of weeks. It seems like some of these darling, asset classes have really started to, industrial, life science, and others, start to see a little bit of a slowdown. So, you hate to follow up the green shoots that we had in office with some of these negative comps, but I do think it's important for us to go through them just to quantify that it's not just headlines. There really are some transactions out there that are showing that the market is in a really tough spot relative to where it's been the last 10 years.
Yeah, I'm surprised, not at the size of the losses necessarily, but I am surprised at the speed at which we seem to be racing towards that word we used last week, capitulation, right? These are capitulation level prices, and we got there very quickly. We've often paralleled the office future to the shopping mall past. The shopping mall past took a really long time to clear and find a bottom. God help us if these office prices are not close to the bottom, right?
Yeah, I think we got to be getting close to the bottom, especially in these top tier markets like, New York City, Boston, Chicago. I mean, they're at some level, you got land values that would be approaching some of these numbers just based on location. So, hopefully, and I think for every participant in the market, the best case scenario of the worst case macro is that you get to that bottom quickly, the bad stuff clears out, and transaction activity returns back to what we've seen before COVID. What we don't want to see is a 5-year slow decay of transactions taking place. Like, let's rip the Band-Aid off, get these assets gone, get them repositioned in the market, and let's start talking about a resurgence in the office market. And listen, it's anecdotal, but I think over the last 6 or 8 weeks, it seems like there's been across all the social channels, my own instance with traffic in the cities, there's a lot of more people in the office, noticeably more people in offices over the last couple of months than what I've seen previous to that. So maybe this return to the office, whatever version 3.0, 4.0 we're on, has a little bit of stickiness to it compared to what we've seen leading up to now.
So Lonnie, this week, our own analyst, Emily Yeh, released a multifamily net operating income report that looked at NOI growth from 2021 to 2022 across various geographies.
Yeah, so this is something we had talked about briefly on our latest Market Pulse webinar, which if you're a listener of the podcast and you're not joining us for our monthly Market Pulse webinar, we would ask that you sign up for those. Myself and Stephen Bushbaum host those monthly. And this was one of the slides that Stephen covered in that webinar. So two call to actions here. If you want a copy of the Market Pulse webinar, you can email us and we'll send you the slide deck and the video that goes with that. If you want a copy of this NOI report, just email us as well, podcast@trepp.com, and we'll send that to you. But what we try to do here was look at the impacts of slowing rental rate growth, signs of softening in the market, how expenses have impacted property operations on the multifamily side, and all those things together obviously lead to what is left over, which is the net operating income. And so we actually go through and look at NOI growth across major markets in the U.S. So in this particular report, we're looking primarily at Freddie Mac loans and looking at what that average year-over-year NOI percentage growth is by state. And we'll have some subsequent reports coming out where we actually do a little deeper dive into some of the line item expenses. And we've talked about this some on the pod in terms of insurance premiums going up, property taxes going up, and personnel costs going up. So this is a really interesting story. Minnesota, not to give away the punchline here, but Minnesota ranked lowest. It actually had a negative 1.4% year-over-year NOI change. And we've talked at length on the podcast about some of the struggles with the office market there. And what we're seeing is in markets like Minnesota and Minneapolis in particular, where there's been a large slowdown in the office market, the trickle down or downstream impact is directly to multifamily. We've also seen it in the DC market as well. On the good side, Tennessee was the highest. They had about a 14.5% year-over-year NOI change to the good. So you look at the factors like net in-migration, development growth, and some new electric vehicle and electric vehicle battery manufacturing plants coming to Tennessee, all bode well for the Tennessee multifamily NOI. So more to come. Great piece. Send us an email. We'll get it to you. You can get some insight.
And let's talk about a big industrial story that we saw this week.
We don't cover a lot of industrial. Some of our listeners have urged us to do more. This one is certainly worth diving into. I'm looking forward to Lonnie's thoughts on this. Earlier this week, Prologis announced that it had agreed to acquire a 14 million square foot portfolio from Blackstone. Purchase price $3.1 billion, sizable by any measure. But the really interesting part of it was beneath the surface, and this was all revealed by Prologis when they put out their press release. The price indicates that it was a 4% cap rate to in-place rents as of today, a 5.75% cap rate when adjusted for future anticipated rate hikes. The one piece of data we don't know is what is the duration of the average lease before it rolls over. So that's an important piece of data to understand if you're trying to get a sense of how they came up with that 575 number. But the implication of that is that NOI will grow by 44% in the coming years if you're going to get from 4% to 575, which is an extraordinarily healthy rate. Lonnie, give me your hot take on both the 4% in place, the 575 on reset, and the growth expectations from the numbers on this sale.
Yeah, so a couple of thoughts on the lead in here. You talked about us not covering industrial maybe as much as the other property sectors. I think part of the reason is industrial is really prone to these large bulk transactions, where you have really big entrenched players in the market that do these large portfolio. This portfolio is 14 million square foot. And, Prologis and Blackstone, some sovereign wealth funds over the last 10 years have really been buying up these large portfolios. So, it's hard to cover individual transactions when you're transacting on 14 million square foot at a time. The in-place or year one cap rate at 4%, I think that's pretty aggressive given where we are in the market cycle. But as you pointed out, there's definitely significant rent growth over some unspecified hold period or time on the lease. These types of deals, I think, are just kind of one-off in the sense that Prologis and Blackstone both have market share and scale that are just outsized for the sector. And so they're able to do things and look at things from the perspective that, ordinary investors wouldn't. I think if you're a Class B industrial proprietor, we have our friend Fort Worth Chris here in the Texas market that has Fort Capital, and he has a thesis on Class B industrial, and I think he's up to about $1.5 billion in assets under management. This probably gives you some really good hope for that strategy. If you can acquire a portfolio and get to a couple million square foot of space, definitely gives you some indication what the big boys are willing to pay for that cash flow. And so I think in that regard, it's a good deal. Prologis and Blackstone, this is not their first rodeo. So it'll be interesting to see. If you look at industrial rents over the last 3 to 5 years, they've outpaced even multifamily in most markets. And so I guess we'll see in about 5 years when Prologis decides to do something with this portfolio. We'll see how well they did.
So let's turn to shout outs. I know, Manis, you have some this week for Key Lime Johnny and our friend on Twitter, BB Dogged Tenacity.
Oh, yes. I had a great day. Key Lime Johnny had me and BB Dogged Tenacity, who's prolific on Twitter, out for a day of golf. It's funny, I bust Key Lime's chops quite a bit, but he and BB both metaphorically stole my lunch money and took me behind the woodshed in terms of our golf scores. Key Lime Johnny was a great host. It was great talking real estate and bonds and office and everything else that went with it. But it's so funny because I know Key Lime by his real name, and whenever I use that moniker, I always think of like kind of a bar band in Florida, like Key Lime Johnny and the Graham Cracker Crust Trio or something like that, playing at some outside tiki bar. But it was a great day of golf and hanging out, and like I said, they both humbled me with their play.
And a few other shout outs from the week. Dave said he loves the podcast. Keep up the great work. Bill Z said, this is the best real estate podcast out there right now. Thank you, Bill. Paul H said, we're a client of Trepp and a regular and keen listener of the podcast, and he's recommended it to all of his team and his other colleagues. Dustin R told our sales team he's a listener this week. Riley N said that, contradictory to some of the shout outs about us being too negative, he'd actually love to hear more stories about the trouble that we're seeing in the market, as well as specifically in the Midwest and the non-top 5 markets. So we can definitely touch on that in some upcoming episodes. Margot L said she listens to our podcast every Friday on her early morning dog walks. Matt H gave us a shout out. Mark S is in graduate school for his MBA and was interested in some of our academic initiatives. So If you're a student, make sure to reach out to us and we can give you more info about that. And then on Twitter, we had a few people who suggested our podcast. So thank you to Saks Real Estate and Black Eagle Real Estate for giving us a shout out and recommending us.
And I have to give a shout out to Three Dog Night, because we were supposed to meet up in Manhattan this week to catch up, but Three Dog had flight troubles, so we missed that. So Three Dog, we hope to catch up in the future. And I have to throw this out there. I got about an equal number of people who like the Trepp head thing, but I got some people that thought that there's got to be a better name for their fans out there. That we may have to come up with a new name for that. I think there was a little bit of pushback that they're not really Trepp heads; they're more academic, more intellectual than that. I don't know. We'll have to come up with something else. So we'll open it up again for suggestions.
And then, so this week, we are all gearing up for the 4th of July. Do you guys have any barbecues or fireworks shows in your future?
I'm looking forward to it. We have almost a 4-day weekend, right? We have Monday's a half day for the trading market, so the markets will close early, Tuesday off. And it's just a great holiday every year, barbecues and friends. And in my case, I'm going to go see Tedeschi Trucks at some point over the next couple of days with my daughters and go see some old friends. And I do want to give one more shout out. I know this guy doesn't listen, but I know some of his kids do. One of my brother-in-laws retired from 41 years in the FDNY this past weekend. And in the past, I've given shout outs to first responders and so forth, but I've been less frequent in that. I've been a little bit delinquent in doing that. But with Independence Day coming up and us being only a few weeks past Memorial Day and my brother-in-law retiring after 41 years of service, I wanted to give the shout out to everybody that keeps us safe out there and runs into places where the rest of us are running away from. So well done to my brother-in-law, Jack, and everybody else out there that's serving us.
Yeah, tough to follow that one up. It's a heat index of about 115 in Texas right now. So it feels like we're a walking firework. And I don't think Powell's reached his inflationary target of 2%. So I'm not sure I'm gonna be able to afford to do a cookout. But all things considered, it's a great holiday. I mean, I think for all of us, it's just a great reminder that we live in the greatest country in the world, and we need more people to believe in that again. And looking forward to a continued recovery across CRE, take some time off, enjoy the long weekend. And we're looking forward to, hitting the ground running again next week with a podcast during a holiday week, with maybe a little light on news, but we'll be back here next Thursday and look forward to talking about what we did over the holiday with everybody when we get back.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the Treppwire podcast with your favorite provider. Thank you for listening and stay well.
All right.